Welcome to Kaizen Time, part of the Blood, Sweat, and Business podcast, where we provide constant improvement to businesses through timely, actionable financial solutions. Do you want answers to your financial questions? Email us at bsp@kaizencpas.com. I'm your host, Mark Valesky. Now let's get started. Welcome to another episode of Kaizen Time. I'm joined by Eric Jordan, a partner here at the firm. Eric, do you know how much, or do you have an idea of what you think Kaizen CPAs is worth? You don't need to tell me an exact number.
Well, that's actually a really good way to put it, right? Because I think if you asked us, if you went to a bank, if you had a formal valuation done, if you went out to the marketplace, and then if you went out to the marketplace, depending on which buyer it is, we would all have very different amounts.
And actually, that's a great point that I want to add to it, because if you're buying or selling a vehicle, if you're doing any type of transaction like that, the value, the number that you can be estimated at when you type it into the internet isn't guaranteed what you're going to get, because it all depends on who's going to buy it.
Well, I do think Kelley Blue Book will give you a guaranteed offer, but
but I mean, it really is true, right?
Yeah, no.
If you can find somebody who's going to pay significantly more, potentially only stuck with people who are only paying significantly less,
correct,
then that's it.
Yeah. Well, just like a private party transaction for a vehicle might yield more than a trade-in versus, or maybe you have a certain dealer that's looking for that particular vehicle. You might get a little bit more out of it too. Or if you're buying another vehicle from them, right? All these little variables drive that. But vehicles are very, let's just say vehicles are very consistent in what they, right? It's a very simple thing to value, right? There's 100 of them on the market. Kind of know what you're going to get from it.
Exactly. And it's a transaction that happens, I'd say, more often, right?
Exactly.
I'll say normal people do these types of things.
Exactly.
But businesses are not anything like that.
They're not. So what is a business worth, right? Number one question. So the way I always phrase this is a business is worth cash flow, so how much cash it generates, times a risk multiplier.
And what is a risk multiplier look like?
Yeah. So generally you'll hear something called EBITDA. So a multiple of EBITDA. So if you're talking about selling your business, you're, having a cocktail at the bar and talking to your buddy about, selling a business, you'll probably hear something about, well, I got 3x EBITDA or something like that. Okay. So EBITDA is cash flow, earnings before interest, taxes, depreciation, amortization. That's a cash flow measurement. And the multiple is your risk factor. The more secure that cash flow should happen on a regular recurring basis for the undetermined future, the higher that number is. So what are things that drive that number, right? Processes, systems, documentation, all those things start creating more repeatable process.
And not having them would cause risk.
Exactly. Right. And the more you as an owner maybe have exited yourself from the business by creating this and creating layers of management, et cetera, the more likely it is that profit then repeats, or that cash flow repeats. Okay. So other things like, hey, I own the real estate. I'm in control of my lease, right? That's a positive multiple driver. The more secure and accurate the financials look, upward multiplier, right? We're more willing to rely on the information as you presented it. All different positive risk factors. Now, there's a secondary measurement called seller's discretionary cash flow. That's what's probably used more in practicality. It's like banks will prefer EBITDA. They like that number. It's a nice, easy number for them to get to. But seller's discretionary cash flow means, hey, as a small business owner, we get a certain amount of perks that we can do. We can pay for our, company-owned vehicle that we may or may not use directly in the business for every little thing, a cell phone. There's all sorts of expenses that are kind of discretionary to the owner. That, hey, if I'm a third-party investor, I might not pay for myself. But because I'm a small business, closely held business, I might be covering those expenses myself. Okay. So those are things that are added back. And then we do like a normalization of expenses, meaning, hey, if I'm taking a salary of 200,000, or maybe it's me, my wife, my kids are all on the books, and really we're only doing the role of one person, we might take the aggregate of their salaries, compare it to what we'd pay that third-party employee to perform those functions, and add back the delta between the two.
Okay. So ultimately, shouldn't be any surprise to anyone that risk will negatively affect it. And the better your EBITDA, the more that you're going to get back.
Yeah.
So when somebody says I 3x'd, what does that number mean?
Yeah. So generally it's either going to be it's probably going to be most likely a seller's discretionary cash flow. So say I made $100,000 a year for seller's discretionary cash flow. My net income, adding back all the expenses, everything I baked through it.
Basically what they would claim as, hey, that's what I got paid for my work.
Yeah.
Okay.
And then we 3x it. So now that means I got $300,000 for my business.
Okay.
Therefore, that's what my business was worth.
I actually heard that this last weekend.
So
I was out and about, and somebody, he was, I think he's like some type of bricklayer or mason person. And he was just talking about how much he worked. And he was talking to a guy who, I guess, sells businesses or buys businesses to sell. We've talked about this many times on other podcasts. And through their discussions, they determined that he could sell it. And he was like, oh, yeah, I made like 3x what I, do. And he's like, I was just able to retire right then.
Yeah.
Just because you made enough.
Well, we're in the wild, wild west right now with private equity as being as active as they are.
Which is interesting because previously we've mentioned like early this year, private equity was down.
Yeah. So it was
back.
And I'll call that a small blip on the radar, right? Essentially, as we had a regime change, the regime change brings uncertainty to the market. Everybody kind of pauses a little bit when it comes to investing and says, hey, we want to let this shake out and play out a little bit.
And this isn't unheard of.
Yeah.
It's very normal.
Every election cycle, we're going to deal with this. And then all of a sudden, right back to where things were. And we're seeing company, a shop, say an auto repair shop that maybe traded for a 3 to 5x seller discretionary cash flow multiplier. We've seen deals up to 10x happening at the private equity. Yeah. So, and I mean, that could be 3 to double of what it normally sells for. So,
well, and again, if you think about it, people want that safe cash. And as we've talked about too, like people will always get their cars fixed.
Yeah.
Until we stop driving places, that is a very safe business.
And that's one of the shifts we've seen in private equity investment is businesses that generate a lot more predictable, repeatable cash flow. So we've seen them draw a lot of interest in various trades. HVAC's another hot industry right now that they're investing in, even down to us as accounting firms. I mean, if you go, actually, I just looked at a Wall Street Journal article and they said that Crow, which is it's a regional mid-tier firm, they're finally opening up their doors to look at private equity investment. So it's thrown the valuing of your business into a whole new bucket. Right now you have another person that's out there willing to spend it. If you have a well-run business, even if that's the direction you don't want to go, hey, now I have an option, right? I can go approach maybe a different type of buyer and say, hey, they're willing to give me 10x. Maybe we do a 5 or 6x deal.
So the interesting thing, and again, this is one of the big differences between a business and a vehicle. Vehicle, typically it's, hey, I need to do this now, right? Yep. Car broke down, need a new one, right? Or it's busted and I still need to be able to get around, therefore need a vehicle. With businesses, these private equities, they're willing to wait too. I mean, they don't want to, but let it be known that, hey, this is a profitable business, and you start saying, hey, I want to retire in 2 years.
Yeah.
That gives both parties some time to kind of button things up and prepare themselves because they're willing to wait to make a profit.
You brought up a really good point, right? So
what was it?
Let's say I have a business. I have 500K of EBITDA right now. Okay. And the way my business is structured, I might get a 3x multiplier on it. So that means if I can do things to make that money more secure, the things I can button up leading up to the time that I do want to sell. If I can increase that 3 to 4 or 5, right? I just took a $1.5 million transaction to $2, possibly $3 million by tightening things up. Let's an extra $500,000 to $1.5 million of sale proceeds to a small business owner. I mean, that's life-changing money, right? That funds grandkids' college. It does a litany of things. So, hey, if you're, my recommendation always is start thinking about it at least 10 years out and have a plan going in 5 years out, right? And we're wanting to improve our systems, processes, things documented, roles, responsibilities defined, have a rock solid employee handbook, have a good set of books and records, make sure your leases are and all your vendor contracts are really tightened up, buttoned up. I mean, there are all these little things that you can do, right? So what private equity wants to see, and that really any buyer wants to see, you got a nice bundled package, right? Here you go. That is worth immensely more than a business that has to, let's just say put on the Firestorm show to get them a single piece of data.
Well, it's the difference between having a shuffled, group of papers versus like, here's my portfolio.
Yeah, you don't want to be the kid that's digging through the backpack and he finds up his paper crumpled up. Like, oh, here's my P&L.
Yeah. Oh, nope, that's somebody else's. No, but it really is true. This is a presentation. It's a sales thing in many ways. So, and not that I am ever trying to throw cars under the bus.
Yep.
But again, I really want to hit home by saying like it's also the difference. So cars only depreciate in value in very rare instances. Specifically, COVID is what I'm talking about, where like trucks were worth more than people were buying them for.
Those are the good old days.
They were brief and good for the people selling them.
Yeah.
But yeah, vehicles will depreciate, and a business can absolutely depreciate.
Yeah.
Or it can appreciate.
Exactly.
Yep.
Right. Yeah. I mean, it all depends on how you build your business, right? And with the right mindset, that I'll plug a book. It's called Built to Sell. And you might think that, hey, that reading that book means that I just want to go out and sell my business. Wrong. That is not what that book is actually meant for. It's for building a sustainable business that will provide you repeatable cash flow. And we've talked about before. Profit and cash flow are so important to a business, not just for the owner and rewarding themselves. Creates a better business for employees to work for. Employees want to work for secure businesses that win, right? We don't want to work for a struggling business that's on the brink of bankruptcy. Yep. They're good for the community. I'm going to volunteer. I'm going to participate. I'm going to do all these things more so in the community. I'm going to provide a better product for my clients when I'm profitable. If I'm scraping by, I'm going to provide something that's scraping by, right? I have different priorities to me. And so it's good for everybody involved when you run a good, solid, consistent, profitable business.
Right. Everyone wins.
And buyers like those businesses too.
That's right. So as we finish this up, how much is a business worth? Like how do we really determine that? We've kind of got some math, but ultimately it is in the hands of the buyers and the sellers.
Yep, absolutely. Well, I'll give you, so for most buyers, I always tell them, anybody can throw out numbers they want. You can go get a fancy business valuation done and pay for that. But at the end of the day, deals get done at the bank, right? How can the deal get paid for? The deal can get paid for and the bank will underwrite the loan. That's what it's worth. If they won't underwrite the loan, they can't get the funding and get the deal done. Doesn't matter what you can agree to on paper. Deal needs to get funded. So I always say deals get done at the bank.
Okay. All right. So how much is your business worth? Whatever the bank is willing to underwrite.
Whatever somebody can come up with the actual money at closing, that's what the business is worth.
And before we do finish this, is there a way that someone could determine this ahead of time?
What their business is worth?
Yes. So like,
absolutely.
Could they go to the bank and have them kind of do like a little evaluation just so they know before they start.
If you have a good commercial lending relationship, right, they can tell you exactly what they're lending on for your type of business at that point in time. You could talk to them. You could talk to your accountant. Your accountant should be able to have what I call paper napkin valuation, meaning, hey, right, we look at your financials. We can get an eyeball of that seller's discretionary cash flow number. And we could say, hey, businesses normally trade at 3 to 5x of that. And you're 80% there.
All right. At least you're in the ballpark, right?
Yep.
Okay. Perfect. Thanks so much, Eric.
Thanks, Mark.
You've been listening to Kaizen Time, part of the Blood, Sweat, and Business podcast. If you like what you heard, subscribe and leave a 5-star review. This podcast has been brought to you by Kaizen CPAs Plus Advisors, providing advisory and accounting services to help you grow your business. Learn more at kaizencpas.com or email us at bsb@kaizencpas.com.